Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. It is Tuesday. Still relatively quiet on the economic data front, but a little bit later today we're going to get some house price index numbers, and we're going to get the JOLTS job numbers. And that's one that I don't know if that number really matters, but the market has been caring about it recently and kind of overreacting to that number. So we will have some opportunities today. Let's come over and check out the charts. We're kind of in rollover season, and it is time to roll over the bonds, apparently. Of course it's time. Boy, I'm so silly. It's 3 days before expiration, right? 1, 2, 3. Yeah, it means it's time to switch. So we'll do that in a second. Let's just come through the charts first. Looking at the treasuries. Okay, so here we get the rollover. The rollover is higher, which is interesting. But, we are kind of pushing on the downside now, the beginning of this session. So coming over to the S&P 500. They fared okay yesterday. There was kind of like, so apparently China was trying to pump the market, and then the market kind of fought them. And then there was that panic bid into the close sort of thing that we see so often today, and a little bit of pullback overnight. Oil having a little bit of a jump this morning. There was quite a bit of volatility yesterday, big jump and then come all the way back, but they're about where they were. Now, silver and gold are kind of pushing on the downside, especially gold. Jeez. Kappa also kind of pressuring. China's still kind of having trouble. Market not really buying into their stimulus efforts. Then we got Bitcoin. Bitcoin has had like a couple of little pumps and then it just comes back. It's going nowhere. It's like they're trying to stimulate activity in Bitcoin and it's just not coming. And I kind of wonder how long it is before there's, somebody else gives up and dumps. And then we've got the dollar looking strong at the moment, 104.2 and kind of on the upturn, which means we should probably come back out here and check. And yes, the Japanese yen is on a tear, 146. That's no good. That's not necessarily good for the treasuries over here. And by the way, we have a 7-year auction today too, so that's another thing that we're going to have to keep in mind. The 7-year, remember, matches most closely to the tenor of ZN, so we might see weird things over here in the treasury. But let's switch over now to the new expiration. I'm gonna switch over to my main face here while I do that. So we need to go to Z now, right? ZBZ. Oh, except for that I don't have it yet. I need to go and refresh my instruments. Download instruments. Download. Well, let's see here. What are you saying here? Collude volumes even. might roll tomorrow. Oh, yeah. Well, I have to say, I was not up. I know that it's like 3 days before the month that you switch, right? But I just didn't think of it. And I think maybe why I just didn't think of it is that the liquidity over in September was not that bad yesterday. Well, was that yesterday's or is that... He's saying that there was slightly more volume in you today. Well, what really matters to me, cancel that, is if I come over here into ZN. Oh, we're okay. I can show you guys what I'm doing here on my screen. So if I come back to Z, December. Oh yeah, we want to be in December. Well, no wait. No, yeah, there's definitely more liquidity in December. Which is what we should expect because, you know, once they roll, there's usually like more liquidity in those other contracts. So ZFZ. Okay, Z. These ones are gonna stay on here until Thursday. Oh, and I need to do these ones down here. ZBZ. Z and Z. ZFZ. So I'm wondering, does the rollover make a difference with there being an auction today? You don't think it matters? Well, if you're doing the auction today, are you maybe already hedged on the old contract? And then you're getting the new issues today, and then you're immediately turning around and selling them or something like that? I mean, how many people would be doing that? Kind of curious. Okay, so we've switched things around. There is a little bit more liquidity over here. It's interesting that they're right at 110 even on the new contract. Overall, though, the volume for the morning, it's a little bit quieter than it has been in days past. So I think that it would behoove us to be a little bit cautious, sit here and see if there's really something going on. Now, there was 3,000 contracts at 0.0.5. So anyways, so I think that this is a good spot to have the opening ad break because, as I said, we're kind of doing a little bit of experimentation. It seems to me like YouTube likes it when we put ads in, and it actually sends us more people if we insert ads. So I am going to insert an ad here. For those of you with ad blockers, I want to say you shouldn't be doing it, but I don't really particularly care. So let's see here. Wait, what? Toyota factories in Japan paralyzed due to, quote, glitch. U.S. stocks are underpricing recession risks? Maybe. Maybe. Oh, what Tucker Carlson is talking about here is part of your diplomacy pushing, social issues. I agree that's kind of not your place, but okay, so let's read this story here that Zero Hedge reposted from investmentadvice.com. Realinvestmentadvice.com. I've never heard of that site before. That seems like something that we should check out. Okay. About once a year, I have to address the issue of chasing the 10 best days of the year. Visual Capitalist recently presented the analysis. There is clear evidence that market timing is difficult. Often, investors will sell early, missing out on a stock market rally. It can also be unnerving to invest when the market is flashing red. By contrast, staying invested through highs and lows has generated competitive returns, especially over longer periods. The graphic below shows how trying to time the market can take a bite out of your portfolio value using 20 years of data from JP Morgan, showing that the difference between being invested all the time versus missing the 10 best days is a pretty significant difference in your portfolio, almost half. Okay. The financial media regurgitates this same analysis whenever there is a market correction. If an investor were to simply miss the 10 best days in the market, they would have shed over 50% of their end portfolio value. The investor would finish with a portfolio of only 29,708 compared to 64,844 if they had just stayed put. What is interesting is that this analysis is almost always the same. We addressed the same in March last year as the market stumbled following the Russian invasion of Ukraine. Panic selling not only locks in losses but also puts investors at risk for missing the market's best days. Looking at data going back to 1930, Bank of America found that if an investor missed the S&P's 10 best days, total returns would be 91%, significantly below the 14,000% return for investors who held steady through downturns. However, as Paul Harvey used to quip in a moment, the rest of the story. The best days occur during bear markets. Here's the problem with the analysis. What about the losing days? While those doing the analysis do mention the losing days, they dismiss the impact. Here is the rest of the story from Statistica. Why is timing the market so hard? Often the best days take place during bear markets. Over the last 20 years, 7 of the 10 best days happened when the market was in bear market territory. Adding to this, many of the best days take place shortly after the worst days. Such was the same conclusion by Piper Stevens in 2022. The firm noted this eye-popping stat while urging investors to avoid panic selling, pointed out that the best days generally follow the worst days for stock. Think about that for a moment. The best days generally follow the worst days. The statement is correct as the S&P 500's largest percentage gain days tend to occur in clusters during the worst times for investors. The analysis of missing out on the 10 best days of the market steeped in the myth of the benefits of buy and hold investing. As a strategy, buy and hold works great in a long-term rising bull market. However, buy and hold generally fails as a strategy during a bear market for a straightforward reason: psychology. I agree investors should never panic sell, as such emotional decisions are always made at the worst possible times. As Dalbar regularly points out, individuals always underperform the benchmark index over time by allowing behaviors to interfere with their investment discipline. In other words, investors regularly suffer from the buy high, sell low syndrome. This is why investors should follow an investment discipline or strategy that mitigates volatility to avoid being put into a situation where panic selling becomes an issue. An investment discipline does not guarantee your portfolio against losses if the market declines. This is particularly true when it plummets, as seen in 2008. However, solid investment discipline will work to minimize the damage to a recoverable state. So, if the best days occur during the worst periods for the market, does it not become more logical to focus on avoiding those periods? While missing the 10 best days of the market certainly does impair portfolio performance over time, what about missing the 10 worst days? How important is this? Over an investing period of about 40 years, missing the 10 best days would cost you about 50% of your capital gains. But successfully avoiding the 10 worst days would have led to 2.5 times the gains over, quote, buy and holds. Wow. Avoiding significant drawdowns in the market is critical to long-term investment success. Obviously, if you are not spending the bulk of your time making up previous losses, more time is spent compounding invested dollars towards long-term goals. Brett Ahrens once penned, in other words, if something is of a wash, the costs of being in the market just before a crash are at least as great as being out of the market just before a big jump, and maybe greater. Funny how the finance industry doesn't bother to tell you that. Costs of being in the market just before a crash are at least as great as being out of the market just before a big jump, and maybe greater. Funny how the finance industry doesn't bother to tell you that. The finance industry doesn't tell you the other half of the story because it is not profitable for them. The finance industry makes money when you are invested, not when you are in cash. However, you do have options. Let me take a moment to be clear. I do not strictly endorse, quote, market timing, which is specifically being all in or all out of the market at any given time. The problem with market timing is consistency. Yes, I will link you guys the article. It's on Zero Hedge, though, which should be easy for you to find. I bet you, I'm betting you what they're going to say here is that you should keep some cash available, and when you have some of the worst days of the market, invest in them. That's my bet, is what they're going to say, because that's what I do. Okay, this is a critical point. No one, and I mean no one, including AI, can effectively time the market over the long term. Being all in or all out the market will eventually put you on the wrong side of the, quote, trade. Such then leads to a host of other problems. Furthermore, ask yourself why no great investors in history employed buy and hold as an investment strategy. Even the great Warren Buffett occasionally sells investments. True investors will buy when they see value and sell when value no longer exists. There are many sophisticated methods of handling risk within a portfolio. However, even using a basic price analysis method, such as a moving average crossover, can be a valuable tool over long-term holding periods. Will such a method always be right? Absolutely not. However, can such a method reduce the risk of damaging capital losses? Absolutely. The chart below shows a simple 18-month moving average crossover study. What should be obvious is that using a basic form of price movement analysis can provide a practical identification of periods when a portfolio risk should be reduced. Importantly, I did not say that risk should be eliminated, just reduced. Here are the comparative results. Notice the max drawdown column. And then they show the thing, and in their moving average model, the CGAR is 6.58 versus buy and hold is 6.87. But the standard deviation is a little bit less. So the Sharpe ratio on the moving average model is 0.48 versus the buy and hold portfolio is 0.4. Interesting. Again, I do not suggest that such signals mean going 100% to cash. What I'm suggesting is that when sell signals are given, that is a time when individuals should perform some essential portfolio risk management, such as trim back winning positions to original portfolio weights. Investment rule, let winners run. Sell positions that are not working. If the position was not working in a rising market, it likely won't be in a declining market. Cut losers short. Hold the cash raised from these activities until the next buying opportunity occurs. Investment rule, buy low. Using some measures, fundamental or technical, to reduce portfolio risk by taking profits as prices/valuations rise or vice versa, the long-term results of avoiding periods of severe capital loss will outweigh missed short-term gains. Minor adjustments can have significant impact over the long run. There's little point in trying to catch each twist and turn of the market, but that also doesn't mean you must be passive and let it wash all over you. It may not be possible to time the market, but it is possible to reach intelligent conclusions about whether the market offers good value for investors. You do have a choice. And that's the article. Oh, that was a good article. I see why Zero Hedge pointed out. It wasn't because it was culturally significant or anything, but it does kind of slice at one of the most common narratives that I see in the market that kind of bothers me. Like, buy and hold is not the best investing strategy. It's just the most prudent investment strategy for most people. But if you're somebody that loves the market and you want to be involved in the market, there are things that you can do to potentially outperform the market, especially as a small investor. And this is another one of those things that happens that just drives me nuts, is they'll come in and they'll say, well, most of these portfolio managers don't even beat the S&P 500 anyways. Well, number one, they have to deal with market impact, which is something you don't have to deal with. So number one, actually, if they didn't have impact, that probably wouldn't be the case. Probably would be the case that most of those people would outperform the market. It's the costs of managing a large portfolio that you don't have that causes them to underperform the market. Number two, when it comes to the hedge funds, the objective is not necessarily to outperform the market. I mean, you could have a hedge fund that it outperforms the market, but the way that hedge funds are used is primarily to have something that is not correlated to the market, rather. So, a hedge fund can outperform during a bear market, for instance. So, uncorrelated returns. And so it is not strictly say, because if that was the case, then there would be no reason for anybody to ever do anything other than investment index investing. Okay. There are a lot of professionals in the industry that are doing something else and making money from it. Why? Most people, though, you should be investing in an index, and you should be investing in an index before you go in and start trying to manage your own portfolio and everything. So, to get off my soapbox, interesting article. I want to go to this website, though. Join RIA. How much is it? Create the freedom that you want. We help advisors choose the best path for their situation. Huh. It looks like this website is basically a front for their investment advising investments. Real Investment Advice is powered by RIA Advisors, an investment advisory firm located in Houston, Texas, with over $1 billion in assets under management. It's not bad. RIA Advisors offers multiple custodial arrangements, either directly or through wholly owned subsidiaries with Fidelity, Ameritrade, TD Ameritrade, Charles Schwab, and Interactive Brokers. So I got a new water bottle, and I'm quite liking it. Ooh, you can see. Oh, not really. Oro. Oh, it seems so hoity-toity and fancy, the name. My goodness. But I like it because it's a glass water bottle with a metal casing. So hopefully this one doesn't break like all of the other glass ones I've had. Man, I tell you what. This is a slow market because we've basically not gone anywhere for the last 20 minutes. Let's come over here to Discord. What is the name of the cash treasury exchange that the CME owns? What's the potential long-term risk on rates of Japan leaving their decade deflationary period? Oh, yes. Well, so I am really concerned about the risks that this poses to bonds, because essentially what it's resulting in is the Japanese yen falling and treasuries falling along with them, and in some instances, Japan selling their treasuries. And I think that at least for the near and midterm, that the era of perpetually low interest rates is over. I don't think that we're going back to zero. We could have a recession this year. Like, let's say that the recession risk is underpriced and it actually happens. I'm starting to feel doubtful about it, but let's say it happens. They're not going to bring rates back to zero. They might reduce rates a little bit, but I don't think that the Federal Reserve would need to do a whole lot. They would only need to bring interest rates back, maybe four rate increases, so like 100 basis points. And then that would probably be enough to bring things stimulative again. And if you do more than that, you run the risk of creating another wave of inflation. So, they're probably going to be careful. And so it is probably the case that like the super low interest rates are probably not coming back. Broker tick. Dead Russian billionaire Yevgeny Prigozhin may be linked to the 5th largest Bitcoin wallet. Well, that's super speculative. Anyways, so the issue that you get is the United States kind of loses control of monetary policy at that point, right? That's the risk. The risk is that the United States would like interest rates to stay where they are, and they keep going higher. And then that kind of almost forces the Federal Reserve to raise their own rate because, if the rest of the market gets too far away from what the Federal Reserve is doing, that's going to really hurt the demand for treasuries. And they're offering a lot of treasuries. So at some point, the rates go up. This is, it reminds me of the whole modern monetary theory sort of a thing, right? Because the modern monetary theory people, they have it half right. They have it half right. They are correct that like you can put stimulus into the economy and you can raise taxes to try and avoid inflation because that's taking the money back. And really all you're doing is you're just at that point deciding which sectors of the economy are going to do well and which sectors of the economy aren't going to do well. based on what the stimulus is that you're giving, right? The problem with that, though, is that there are other dynamics that go on within the market that doesn't control. For instance, interest rates and currencies. And you can't necessarily come over here and have the United States be like printing insane stimulus and having super high tax rates. And meanwhile, you got this stuff going on in Japan where they're raising rates because of inflation, right? And then you can't keep interest rates low over here. They're going to go up on you. And if they don't, then people are just going to flee your currency. And that's a big problem, especially when you already have a super high debt burden like we do. But then that's also like the larger problem that we have, which is how do we deal with the large deficits that we've run? And I really makes me mad thinking about it, because it's not like the conspiracy theorists say, where it's like, the dollar's going to collapse and yada, 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 yada. Okay, but there are real costs to what we've done. And the thing is that sometimes you do need to run deficits, right? And basically what we've done is we've wasted that power on situations where I don't think it was really necessary. And I'm not sure that it really helped us. Like the pandemic, kind of avoidable. That was kind of our choice. Like realistically, was kind of our choice, right? And now we've taken on a huge debt. And if something were to happen, like there was a war with China or Russia, heaven forbid, don't think that that's likely to happen anytime soon. But if it did happen, we'd be pretty screwed because we wouldn't really be able to take on much debt. And one of the things that happened kind of at Jackson Hole and with the ECB and all of these other things going on is they're basically saying it's not feasible to fund all of this just through inflation. Which means at some point probably entitlements will need to be cut, taxes will need to be raised, etc., etc. Okay, well, I'm seeing pretty decent selling across the board here. In the treasuries, at least. Totally makes sense to me that we could be having some selling today. I don't know how persistent this will be. We do have news later in the session, so... Now, one of the issues... Oh, okay, so first we're gonna get the... We're about to get like the housing numbers and stuff. So let's at the very least let that happen first, right? I don't know, when an asset is like really dull and nobody's paying attention to it, that would normally be like a good time to buy. But Bitcoin right now, it is that there's no interest in it at this time is I find very concerning. That if they're not able to generate any interest down here, that it kind of suggests that maybe the peak Bitcoin popularity is already past. Well, geez, the treasuries moved a little bit there off of the news and so forth. So we got the house price index year over year 3.1 and house price index month over month spot 3 versus an expected spot 6. So it looks like, but the Case-Shiller 20-year was negative 1.17 versus negative 1.6. So I don't know if I see anything too significant in there, but there was a little bit of wiggling around there. Didn't seem like they were able to get above the 110 though. Oh, you know what? This realinvestmentadvice.com one, Zero had just posted a lot of their posts actually. Kind of watching it here, for some reason they don't want to mess with this area. It's definitely giving me like the low liquidity signs. That's tough because I kind of have an inkling that they might decide to move lower at some point, but it's at the moment it's kind of given me the like, we're not going to do anything. Maybe you can help me. For some reason, the DOM is only showing me one depth for the bid and asks, do you know what that could be? Well, the first thing that I would check is to go into your settings and look at your market depth setting and make sure that it's more than 1. But if that is set correctly, are you sure that you are getting full level 2 depth from your broker? You may need to talk to your broker and have you get upgraded to full market depth data, which is usually about $30 a month. Yeah, and if you're connecting directly through Jigsaw, that strongly suggests to me that you need to upgrade your data. That you're only getting the top of the book and not the full market depth. Okay, so we did see some selling there before the news and everything, but they have since recovered that. So I would say that while I do have some evidence of a meta order out there, it's not enough to be conclusive on its own. It maybe would have been enough to have taken a trade short to begin with if I was strongly suspecting a sell meta order today. But I'm not so sure. So there is an auction today. Does seem like the path of least resistance has been down. We're getting the rollover. Or no, I suppose one of the things that tends to happen is when you're on a new contract and you get trends, they can be really strong trends. Because, you know, it's like new people taking positions in contracts. So if there does end up being a trend, we would probably have plenty of room to be able to jump on it at some point. So I don't know if I need to make a so speculative of a play at this moment. Oh, you know what? I never put my watch back on. Hold on. I don't like to have it on like early in the morning because my wrist swells up. But once I've cooled off, I should put it back on, and I forget to do it. Oil's seeing a little bit of a downtrend, and Bitcoin seeing a little bit of a buy. The dollar okay, so I'm hearing over the news squawk some talks about preparation for the hurricane, and they're saying that their oil production should not be affected. Perhaps that's why oil is selling a little bit this morning. Uzi says yay. By the way, are you all prepared? When this was first kind of popping up, the way that the news was presented to me was kind of like, it's not a big deal. But it's sounding like this is going to be a pretty big one. I was also thinking this morning, September tends to be the worst month for markets. How much of that is because of hurricane season? Because that's one of the seasonal factors that does affect us here in September. For us, it's going to be rain and breezy. Okay. You're not going to take the brunt of it, basically. Not in the direct path, but boy, howdy do we need the rain. Oh, really? I thought you were getting a lot of rain down there. You should be getting a lot of rain down there because of El Nino. El Nino means little boy. Negatory. It'll come. Don't worry. The El Nino is only just starting. It's probably going to be a wet winter for you in Florida. Down tick. I like moist. I don't get the joke with the word moist. Why do people? It sucks. You can't trade like this without having the full depth of market. Yeah, that would bother me too. I got a water bottle yesterday. I moved to Jack's after Ian S follows me. Wait, what are you talking about? There they go. Stops. Actually, you know what? That was not too much. They mostly pulled. They mostly pulled and only a few hundred contracts went off. I actually find that a little suspicious. I mean, probably I should go along with it, but I find the way that happened a little suspicious. Well, part of it could be because of the rollover. Maybe the activity is not completely there in the new contract yet, and that's why it seems like it was so few contracts. There's definitely a few hundred puking here. But I'm a little suspicious about the market. It seems like the market makers are pulling it. I guess on the other side, when we have moves down, that's often the way that it plays out, huh? Because people associate moist with vagina. Yeah, probably. Okay, here's a Jack's shaker bottle. Yeah. I'm telling you, glass just tastes better. Glass just tastes better. Get yourself a nice glass water bottle with high boron content or whatever it is. Borosilicate glass. Okay. 1700 at 29 now. So that whole time I was considering 23. And remember I said I don't know if it makes sense to make such a speculative play. So I passed on it and missed the opportunity. But at least I was kind of identifying an area that had good value. But well, okay, so about half of it has come back. I'm a little bit suspicious of that move. I have to see how it actually plays out. Because if it really is, you know, sketchy games, it'll probably come back real quickly, right? Oh, geez. Okay, so do you have sound notifications on every new tweet on the new Pro tweet deck? I know the legacy version did, but the Pro doesn't seem to have sound. Okay, so they kind of messed around with it for a while when they switched everything over to you have to be what do they call it? Verified or whatever to use TweetDeck Pro. Like you have to be paying the subscription. But once they did that, they gave you the option to opt out of the new TweetDeck Pro. So, yeah. So you could go back to the old ones if they have sounds that you need or something. But I never used that, so. No. You just need to go into the settings and say opt out of the new X Pro or whatever it is. I can't recall exactly where the setting is, and because I've already opted out, I would take a little bit for me to go find it. but somewhere in the personalization settings, you can change it. Okay, well, from what I can see, that little drop did have its impact, and I'm not seeing people hit back hard the other way. I'm putting a little feeler out there and they're not hitting it though. ZN gap up. What's with that? Probably because you have your chart set to merge contracts non-back adjusted and rolled over your instruments today, resulting in ZN having a gap up overnight. Which is the way that I would do it, but yeah, you can have a little gap. The real question is, why were we in such contango or whatever? Sucks if you were short. Well, no. Your simulator is not handling the rollover correctly. That does make me wonder for the contest. I did like in the test portfolio. Will they kick me out of the position now? What will the sim do? Okay, well, they weren't quite able to recover the prices, but we come back to the top of there again. They're putting some pressure on me. I'm seeing some a major tick the other way, so that's not the way that we want to see this play. Oh, geez. So there was a little bit of back and forth there in the 10-year, at least. Yesterday was the lightest trading full trading session of the year with 1.8 billion shares trading across exchanges. Really? That kind of makes me reconsider what I'm doing here. It's kind of a question of how stubborn should I be with this, and I'm kind of feeling like I should not be very stubborn at all. Oil seems to be stabilizing a little bit. We're not getting any kind of move in the S&P 500. Now is a good time for a commercial break just before the E-mini starts. So we'll be right back. Oh dear. What now? Oof. Okay, so I am detecting a hint of steepening in the curve, even though the 30-year is up more. Like, the 30-year sold really hard. and is still pretty negative. And the buying was more so in the 10-year. But the liquidity is looking okay here. There was actually a decent amount of trade in through there. I'm gonna take the loss there. That kind of sucks because I didn't get really any favorable excursion on that one at all, did I? Well, good for me to have failed, but it is kind of doing some fishy things here to me now. There was a couple of strong upticks and they just immediately like gave up 2 ticks. Although, with the way this is going, I do kind of have to wonder if it's not just the market maker completely in charge, right? Well, we've got the S&P 500 open coming up, and then we do have some fairly significant numbers at the top of the hour. Numbers which, by the way, the risks are kind of tilted towards Jolts is too good and we sell again, right? Well, should the government be giving subsidies to pharma companies to develop vaccines? Not anymore. At least I think. There's another down tick. I feel like the treasuries are being a little more tricky than usual. Maybe that's because it's trading such a tight range. When those downticks come in, they're kind of heavy. There's some volume there in the micros. 30 years still would need to come down. Yeah. So one of these guys asked, do all pumps of the day have some explanation related to news, or sometimes are they just random pumps? And I went into it, well, no. They can be endogenous, which is created purely by traders trading. And this guy responded to, OP really just fought its way into the excess volatility puzzle. Yes, he did. That there's more volatility than can be explained by fundamental changes. Yes. I'm really tempted to take another contract here in this situation, but I don't think that the market action justifies it. Like, to be honest, I'm still kind of wondering if I should even be in a position. Went long on yesterday's low on ZB, out for a few ticks on Sim, though I'm not trading on a top step account before I resolve this no leverage stuff. Well, okay, so that's interesting because, first of all, that means because you were asking about the depth before, right? And I'm odd that you would not get full market depth with a top step account. The other thing, when you're saying no leverage, like, I would not be taking more than like 1 or 2 contracts in ZB anyways. If you're like on a standard combine. Of course, depends on the strategy and everything, but just trading one. I tried with 1 ZB contract so many times, and I tried with one ZN contract so many times, but and I have had periods that would have passed the combine, but by that point I had moved on and was just trading my own account. I tell you what, this is an odd chart. Okay, that's my sign. What happened there? That was a little weird. Hey, Francesco. Oh, it did take it. Oh, I see what happened. What happened was I clicked in because I tried to go as she goes as it ticked, and then I thought that I had gotten a bad price or misclick, and so I tried canceling it. So I immediately canceled it, but The reason I had gotten the dings and the error messages over here was because the oh my gosh, was because the order had already gotten filled. So I did get a second contract, and as soon as I got a second contract, the treasuries all shifted like big time. Like that, it was a wild move. That was really weird. That has not happened before. I don't know. I guess maybe it has, but it was like they were going in on the sell, and there was like big iceberg there, and then they almost immediately reversed so quickly. That's really odd. I guess what that means is that we are in a relatively low volatility regime with where, you know, a 4,000 lot iceberg has, you know, a big impact on price, and so because they didn't clear it, they reversed hard like that. That was really weird. Welcome to rollover. Yeah, I guess I'm just really what is the word? I'm just really taken back by how quickly that flipped on me. That it went from the instant that I was like, oh yeah, let's push this, and then it completely reverses on me. Like, whoa. That's a little terrifying to me. Can you tell? Like, I'm a little shaken by what just happened there. I guess mostly because it worked out against me so badly. Jeez. Okay, well, I think I know what's going on, but that also kind of brings into question some of our larger, like, questions and thoughts about what's going on in this market. Seems like that there was at least somebody there on the buy and the sell side, but that the buyer won out that time. And the size of these things is relatively small, but it's having a really strong impact on the price right now. By the way, what's the Japanese yen doing? Not anything. What's the dollar doing? Not anything. So it was purely in the treasuries. The ZB, like, reversed super hard. Now it's doing the thing at 01. But CB is still pushing. You know, it's true, Kulud. I usually have trouble around rollover. Like, after rollover, we get some of our best trades, but like going into rollover can be some of the most difficult times for me. The 5-year looks like it's actually kind of selling now. I don't know. Nope, uptick. Doesn't hold. Yeah, I don't know, Uzi. Well, because I think that it was temporary I don't know. Maybe I'm just crazy. But I'm thinking that I had the trade wrong. It was temporary impact by that big order. That impact should be over and it should settle back down and probably come close to where it was. I take bigger losses on, well, that might be true. I take up more than a 31. Okay, well, it did tick back down to 10, so I don't know. This is pretty freak action for the treasuries, though, isn't it? They were scared that you would make more money on more contracts and they wanted to discourage you. Yeah. That's exactly what happened there, man. Because it did move, like I was catching it as she goes. I caught something there, like that contract that went in, that normally would have been a good as she goes play, and it is like an absolute freak sort of, you know, I have never had in a situation like that when I go into it and it reverses that hard that quickly. Usually that one is like you go in and then like nothing actually happens and eventually they give up and then it eventually comes back, you know? That was just really weird. When you're in a trade where there are nuances / behaviors in the order flow that suggest you should stick with it or close it, I'm trying to learn how to create expectations for the order flow I want to see. When I open a trade, so I immediately know at the very least I am more aware whether the market is doing what I want or not. I've been thinking this for a while. I'd like to know more about your approach. Is it the way the latent liquidity reacts to market orders? Yes. Well, the first thing is that I want to see the orders going my way. Okay. Which is to say, I want to see more market sells than market buys after I get in. Okay. So like, part of why I'm holding this, fuck. Well, and now I do have to puke. That was one of the like worst trades. like it wasn't like the worst trades in terms of like what I did and how I handled it and all of those things, but just like for how badly it went so quickly, that was really discouraging. and really scared me. So, and I felt like it was coming back, you know, and I was like, okay, no, it's okay. It's doing what I think it should. And then they came right back up there, and I couldn't handle it anymore. Okay, but to the question, okay, like we're not getting what we want to see, right? Because I got in here. I got in literally like right here saying, okay, I'm going to see more selling because I'm getting the selling right here. And then what happened? It reversed really hard. And then after that, am I seeing selling? No. I mean, cumulative delta slowly going up. It kind of suggesting to me that the market maker must be in control and that it's just doing screwy things that I don't understand. Right? Right, wrong, I don't know. The way that one flipped on me so hard was really wild. I mean, there was nothing I could have done about it because like as soon as I took the trade in there, I was down like $30. Just like that. So there was nothing I really could have done to like, you know, once I got in to like managed it faster or anything like that, wouldn't have mattered. Wouldn't have mattered. Well, I could have had a closer stop, maybe, but I think I still would have puked into pretty bad orders. Yeah, anything can happen anytime. It really was like an outlier, right? Like that's the sort of thing that will bother me the most is like you'll see some behavior, okay, that like almost never that never happens, or it's just really incredibly bizarre, right? Okay, like things happen, but how is it that it happens like exactly when I took a second contract? Right, they're going to spend $100,000 to get you 30, which wouldn't really make sense, but I can't explain that. Well, I think that the only reasonable explanation is that what was making me think that that was a place to go as she goes was because it was a lure, right? I would also say I don't know if it's really like $100,000 in this kind of a situation. Like, I think that before that big order, you know, we were kind of in a situation where every little order can do something. I guess I really shouldn't have been touching it. Because that really makes me think, oh, okay, there is a meta order, but it's long. But then I give pause and I'm like, maybe not. Because at the moment, it looks like they're just balancing out after that order. Like there's 4,000 down. And so now the 4,000 that sold have to buy, and that's what's pushing it up. And they're about even. So now I'd say that everybody's been squeezed out. And you can see it could have been worse for me, right? It's frustrating because I haven't been trading very well this month in general, right? And I felt like I was getting my feet back out underneath of me, and it just gets swiped again. And it's been a while since I felt like we've really had like a really solid like reason to. My approach has been to be very scared when I am short. There has been like some squeeze, like short squeeze behavior in the treasuries lately, hasn't there? Like especially the latter half of this month. It seems like every time that they start turning down, JP Morgan is there to buy it back up. I'm convinced that it's JP Morgan that hates me. Because they're the ones that have been saying buy the bonds. No, it hasn't been a good morning for me. The only thing I can think of that was like where a position went worse for me was that time when I caught 40 ticks of slippage on ES. That one was really like I was there like one of the only ones that puked on it, and 40 tick slippage, like how the heck does that happen? No, it wasn't because it was too illiquid. I had nothing to do with that. So when I got out, the liquidity was okay. I would have taken as much of a loss if I had been in ZN, right? Well, what happened, Gary, is I was trying to catch the edge here at 30. And like as soon as we did so, an iceberg showed up. You can see that 4K. And then the treasuries reversed like 5 ticks just all at once. So we were messing around 30. We lost to like 20. Wait, where was it? 217. So somewhere around here. One thing that I should be, a pattern that I've been noticing that I just keep falling victim to is that, like, if it sells early. And if it doesn't start selling early, then the buyers come in. Okay, but do you think that watching how the bids and offers react to market orders can give hints on whether it's a good time to take profits? Take a loss? Well, yeah. So I'm sorry, that just really affected me. Okay, so when I'm in a position, I want to see that those orders are behind me, right? I also want to see it on the limit order side. So I want to see, if I buy it, I want to see those bids being firm and those offers kind of pulling. That if they hit into the bid, that it requires a lot more orders to make it tick down than it does to make it tick up. So, which kind of suggests that the bids are stacking and the offers are pulling, right? So remember, there's 6 forces. There's market buy, market sell, limit buy, limit sell, limit buy, cancel, limit sell, cancel, right? So I want to see more limit buys being placed and more limit sells being canceled, and more market buys. Those are the 3 forces I want to be strong, and then the opposite I want to be weak, right? The other thing that I'm going to look for, though, is large transactions happening at one spot. Large transactions happening at one spot. Price sweeping through an area very quickly. And then after those things happening, the amount of resting liquidity being offered at any one time being less. So right now they're like offering between 500 to 900, right? But if there was like another 5K order here, and then all of a sudden they're only putting up 100. So right now there's only 124 there, although I bet that changes if they tick up. You know, that's something that might make me think that that leg is over. Well, I haven't seen anything new on China's stimulus since last night, and the market just continues to be like incredibly, how do you say, skeptical that China is really actually going to do what it takes. I don't know. I don't watch the 2. Well, I watched the rate on the 2-year. Yeah, it's the bottom left, far left on the bottom row. Well, it was giving me a little bit of a sign of that kind of low resting liquidity, but there's still kind of pressuring the upside here, so. The issue that I have is that I'm still kind of seeing this as the market rebalancing after that large iceberg showed up. So I don't think I can make any conclusions about what it's going to do next. And on top of that, I'm definitely tilted. 2 losers and one of them being really big and just going against me so fast is just awful. So I'm definitely going to sit out for the rest of the day. There's a down tick. Find some trends that are easier to trade than others? Oh, no. I mean, there are different types of trends, and I have a video about that. But what makes something easy to trade or not is the quality of the information that you have to get you into the trade in the first place. You know, I have some information that really, really strongly suggests that there's going to be buying today. You know, and I can hold to that. It makes it a lot easier, and you can interpret everything that you see in terms of those flows that you know are supposed to be coming through. Today it was like, well, we know there's an auction. We know there's a little bit of economic news, and we can see it kind of doing some shifty things. So I was willing to take the bet. I probably shouldn't have, because I had to take a little bit more of a speculation on that they were going to be going short in order to do that, right? And in the end, I ended up being wrong on that one. The meta order was definitely the other direction. Now, it was only about 5,000 contracts the other direction, but it was the other direction. And 5,000 contracts moving us all the way across that range says to me that this is a dangerous market to trade and that I was wrong to mess with it. That I was right that there was an opportunity in there, but that I was wrong in my ability to be able to predict what the flows were going to be. It is kind of moderating up here at 04 though. But for it to do it like right there up at the high, that's kind of that's not very indicative of reversal, is it? Well, when that happened, the S&P 500 reversed, went higher, but from what I can see, this was a move driven primarily by the interest rates. That's a little wild, isn't it? That's an example of the square root law. That's the perfect example of how the square root law can lead to a small subset of orders having an outsized impact on the market. Because basically what happened there was 5,000 contracts resulted in a complete reversal in the treasuries, and lower interest rates seems to have buoyed the equity markets as well. Also makes me question the whole path of least resistance is short. Okay, so now they're pulling for jolts. Let's see here, where is it? Jolts, we're looking for 9.5 million, and CB consumer confidence, we're looking for a reading of 116. Ooh. Oh my. Jobs openings 8.827 versus an expected 9.5, and consumer confidence 106 versus 116. So both numbers were very negative. And the treasuries result in an upturn, and so does the equity market. So one must now wonder how much of that action was somebody knowing that what the news was going to be. And I thought that the news would be bad. So, wow. Because like we were looking at 4.2 and they just plowed through that, right? And it's still going. Wow. Wow. Well, I think that explains everything that we saw here today, doesn't it? I think that that's a much better explanation than all of the conspiracy theories that I had. That is a wild move. Like, we're down now almost 9 basis points on the day. So the newspapers are going to start talking about a recession once again? No. I don't know. So I would say that what we're seeing, so number one, I really don't trust the JOLTS numbers. Okay. So that's the first thing. But number two is that all of the well, not all of that, but a lot of the things that we're looking at and so forth kind of suggests that the job market is not as strong as it has seemed. And so it looks like the numbers are kind of coming into confirming what we thought we already knew, was that the labor market is not as strong as it appears, that interest rates have been affecting the jobs market. Now, the thing with that is that that's all kind of like good. That's like what the Federal Reserve wanted to see in the first place. So it doesn't necessarily mean a recession. It means a period of softness, but would it actually ultimately be good for the economy and allow give them more room for the soft landing potentially? That's why the S&P 500 is buying so hard on this, right? Because the S&P 500 is not buying super hard because they think there's going to be a recession now, right? Gap up for sure. Well, no. The gap up had nothing to do with that. So if you come over here on the volume profile and you're looking at ZN here, okay, and you're saying, oh, look, there was a gap up. That means that we're going to bounce higher. No. Okay. Because this gap is only because of the rollover. The December contract was always higher than the September contract. So if I were to try and show you, I'm going to duplicate a new window here. And then I'm going to change the data series here. I'm going to, and I'm going to add here ZN 0923. $30-minute. Okay, and then I would need to come into my tools options and say market data. Oh, yeah, no, I don't think that we need to do that. I don't need to do that part. But I do need to come in here to the data series and have this one have 90 days on it. That's what I need. Okay, then I'm going to delete this series right here. I'm going to move this up to here. Oh, I guess I do need to do that. Don't merge. Tools, options. Yeah, the December contract was always higher. That explains that. Okay, cool. I'm still gonna try and there you go. So now you can see. The December contract has been higher for a really, really long time, right? So, you know, that gap was basically something that you could have predicted was going to happen today, like 90 days ago, essentially. Anyways, I'm going to come back over here. I do like to have it set as merge non-back adjusted. Well, little bit of a pullback. How do you handle the rollover? Well, so I do not typically hold a position through rollover, so it doesn't affect me, right? I come on the day that it's going to roll over, I switch all of my instruments to the other contract, and then I trade as if nothing happened. And I'm a little bit cautious going into the rollover because the action can be a little bit difficult going into the rollover. And then after the rollover, I'm a little bit more aggressive. Jeez. Where's the best? Okay, so the best way to know the rollover date is to just know how it rolls over. And the way that it rolls over is 3 days before the end of the month. So you can see here the first call is the first, right? And then you go 1, 2, 3, and that's going to be the last day that's going to be the rollover day, basically. Sorry, did I say that the first was first call? I can't recall. If you, my recollection is that if you own the contract tomorrow, you could potentially get called. Okay, so that's why we all switch over on the Tuesday. And you can start switching before that, but the Tuesday is when you're going to see the most of it switch. Well, yes. So it's different for every contract. You need to understand the rules for the contract that you trade. For the S&P 500, it's the week before the options expiration. So if options expiration is the third Friday of the month, right? 1, 2, 3. Except for it's in the expiration month. So the expiration month for S&P 500 will be September, right? So if we come into September, it's going to be 1, 2, 3. So 15th is expiration. Okay. So it's going to be the week before that, and then the 1 day before that. So for the S&P 500, you're all going to be switching over on the 7th. And I just know that because I've had to program stuff for backtesting the equities before, right? So you're going to have to know for each instrument. For a lot of these ones, the ones that expire like month by month on the micro treasuries, whoo! Look at them go, man. Holy shoot. Oh, man. This is... Oh, how big of a move is this? Okay, so it's not as big as the was that the Friday, August 4th? Was that non-farms? Yes, it was. It's not as big as non-farms, but it's pretty darned close. So let's measure this, shall we? I don't know if I've ever been showing you the charts, but so I can come in here and I can use drawing tools, a ruler. Here it is, ruler. And I can say from here to here. Okay. It's 50. And I'm going to do the same thing over here. I'm going to say ruler. Oops, it's at the top. I'm going to go from here to, let's just measure the single prints area. 42. There's 50. So, I guess that would kind of give me reason to think that it's going to pull back considerably, but so I don't think it's as big of a deal as the non-farms that we had, right? Okay. It gave a big, long blurb to somebody in Discord there about how we trade this, but can you remind me how you use the 3/5 law after a big move? Yeah, so I don't know if it really applies in this situation though. What's going on here? Oh, okay. So if we have a move like this, you're going to get the square root law, which is to say that as the number of orders increase, the impact that that increase in orders has decreases. So if we were to graph it as number of orders and impact, it's like this. And that's what you're seeing. Okay. Now when that ends, there's going to be a 3/5 decay. Okay. So that means that this, how do I do this? That means that when the meta order, when these guys all chill out, we can come in and we can use a time extension. Say, well, we're not done yet, but let's say that we're right here. Let's say that it ends right now. Then we will see a decay. It will take us out to about 840. So about 45 minutes. Usually it ends up being about 45 minutes. Okay. 8:45 after the news. Yeah, seems about right. And it will decay as this 3/5 law, which you would have to take it the other direction. So like, what is 3/5 of this? Essentially. Right. Ruler. Oh, I see that it's actually 41, not 50. Okay. So I come in and I take a calculator. 3 divided by 5. 0.6. 0.6 times 40. It's 24. Which, what do you know, ends up being like right there where the single prints start. So if I was looking for like a space, like a good value area to go long, somewhere in there. So something like 15. I don't know if it'll get that quite that far back. I would be more like buying at 16. But it's not stopping right now. It doesn't look like the meta order's over. We may be in one of those situations where these laws don't really matter because the market has become so disjointed. I mean, and these are the sorts of situations where that happens, right? Well, I kind of feel like that after a move like that I should have some opportunity, but I think that it's probably better that I sit on my hands. Obviously I was taking the wrong trade. I got scared out of it. It really sucks the way that it happened because, you know, I think that I would have gotten out that earlier if it hadn't been for that iceberg and all that kind of stuff, right? Jeez. By the way, I think that this is like the 10th time in a row now where I've felt like the flows were able to front run, per se, the news. Oh, what's this? They want to do a meeting today. I might have to leave early. Took the right trade at the wrong time. No, I took the wrong trade at the wrong time. Yes, they want to do an early meeting. So we're going to end the stream in 10 minutes. I definitely have to chalk that one up to bad luck. But at the same time, I probably shouldn't have been taking a trade. I guess it ultimately... I was more concerned about jolts being better than expected again, and I was wrong about that one. So there's been a shift, and I was behind the curve. I mean, I got what I deserved. And this is where it always comes back to, like, the real difficulty here. Like, when you compare what we do discretionary trading to like technical trading, for instance. Technical trading, you're kind of at the mercy of the markets, and it's really, really difficult to find something. But if you do find something, you just do the thing and it should be consistent. And especially if it's a really good, like these market making scalping robots, right? You get really consistent winner, right? Whereas when we're doing it discretionary, there's going to be a lot of edge for you to find. And so it's easier for you to be able to come in and find an edge and find a piece of information that you can use for your trading. But the disadvantage of it is that even if you're completely on, it's not going to be as consistent, right? You're probably going to win still like 50% of the time. And when you're not in line with the market, when you're not really the informed one that knows what's going on, it doesn't go very well. And it's very, very difficult to really be at the top of your game all the time. And in August, Seth was not at the top of his game, was he? Not at all. And there's kind of those difficulties in trading. So I think that takes our loss here for the month to 180, doesn't it? Yep. Actually almost 190. That's awful. So it's basically all of the work that I'd done all year gone in 1 month. That's rough. Well, this is why I keep telling you guys, why aren't we sizing up? Well, I think there's still some bugs to work out. There still seems to be certain periods, certain types of markets that I don't understand enough to effectively trade and or to keep myself out. A lot of what brought me the success earlier in the year was staying out. So, well, this makes what the jobs number on Friday is going to be really, because the jolts has not necessarily been a very effective predictor of that, right? So it'd be very, very careful about assuming that this is going to predict what the non-farms number on Friday was going to be. I suspect that the non-farms number on Friday is going to be a little bit weak. Actually, let's come in here. Forex Factory. Put the title of today, Bad News is Good. I guess we need to go in here this week. My settings. Non-farm employment change. Okay, well, if they were worse than expected, significantly worse than expected, that would be a little weird because the number that they're predicting is already like a really low number. In fact, the consensus estimate, 169K, would be the lowest. Wow, even that one is lower. Yeah, it would be the lowest since like the spring of 2021. So they're predicting a pretty low number. Although I think that 160 is still in line with like what would we call it? Like neutral, like to keep up with population growth 160 is what they need to hit each month. It's around there. So, to put that in perspective. But if it was significantly lower than the expectation, that would be a little wild, right? That would be, like if we got 120, that would be a little eye-opening. Then maybe I would start thinking, oh, maybe we really are moving into a recession and all of these other kind of tea leaves that I've been seeing were like way ahead of. Oh, what's this? I'm just getting I didn't hear what they said. Petition for Grayscale Bitcoin ETF review is to be granted and the commission's order be vacated, says a Twitter source. Okay. I don't know what that all of that verbiage seems weird to me. U.S. Federal Appeals Court rules that the U.S. Securities and Exchange Commission was wrong to reject application from Grayscale for spot Bitcoin ETF. Whoa, really? Can they do that? I'm getting it from like multiple online sources, but I'm a little bit worried about this one. Like Bitcoin can do shady stuff like that, right? But if it was true, that would be a big deal. Although they can petition again. I guess we're going to have to read a lot, but if Grayscale did get their spot ETF, jeez. Yeah, that is, oh my gosh, like the number of tweets that I'm just seeing coming through now is nuts. Okay. I think I can say that this news is confirmed. DC court ruled that the SEC improperly rejected the Bitcoin spot ETF. The court ordered the petition for review be granted and the commission's order to be vacated. The cause came on to be heard on the petition for review of an order of Securities Exchange ordered and adjudicated per opinion, blah, blah, blah. Like, so they have a picture? Jeez, I don't know. I don't know, man. I need the full court documents. I need the full court documents and like read the decision and stuff. But it you know, just assuming that it's true, you could probably buy Bitcoin. I think that I would be buying anywhere below 2,800. I'm really shocked, though, that they can say that it was improperly. Like, really? They can do that? That's not how I thought it worked. So I'm a little surprised. But I'm sure we'll get a lot of analysis. I got to get going. I will see you guys tomorrow, and hopefully we have a better day than today. In the meantime, stay excellent.